Chapter 5, and we're going to now look at Part 2, and we're going to look at contribution margin, break-even, and targeted sales. Now, how do we predict financial future? Well, we came up with some of these methods, but remember, it assumes you can break down your cost between variable and fixed, because otherwise you can't use these analysis. So, components of cost, volume, profit analysis. The price charged for each poster, you need the number, you need the volume, you need the variable, and the fixed costs. And then you're going to be able to see the effect it's going to have on your operating income. These are powerful tools that help managers make decisions, express relationships among cost, volume, and the company's profit, and determine sales volume needed to break even or earn a targeted profit. So, assumptions. Sale price remains constant throughout the relevant range. Managers can classify each cost as either variable or fixed. It's very important or this doesn't work. Inventory levels will not change. The product mix offered for sale remains constant. So these are the things, the assumptions you have to have whenever you're doing this kind of analysis. So let's look at our contribution margin and the contribution margin ratio. So, contribution margin is sales minus variable costs. Unit contribution margin is selling price per unit minus variable cost per unit. All variable costs, product and period, must be included when calculating the unit contribution margin. So, contribution margin ratio is the percentage of each sales dollar that is available for covering fixed expenses and generating a profit. So it's going to be the unit contribution margin divided by the sales per unit, gives you your contribution margin ratio. Unit contribution margin to predict net income at different levels of sales. So Mike has the following contribution margin. What is the contribution margin ratio? If the relevant range is $200,000 to $640,000, prepare the contribution margin statement at $200,000 and $420,000. So first, what is our contribution margin ratio? It's going to be, we're going to take our contribution margin and divide by our sales. We can do this in total or a per unit basis. So what I like to do is do all three. So if we know our variable costs are 24% of our contribution margin, it helps us determine what those are, and always assume that sales is 100%. Now, the relevant range, we have that, and we're within the range. So sales are at 200 and 420. Now we're going to use our contribution margin ratio to figure out our contribution margin, and then we can work backwards. Or we could have just taken sales times 24% to get our variable cost. You would have got the same number, less our fixed costs, and that tells you our operating income. So at $200,000, we're going to lose money, but at $420,000, we're going to make money. Now, using the contribution method to analyze to find break-even. Now, targeted profits is break-even plus the profit you hope to achieve. So, again, break-even can be stated in units or dollars. There's three methods: the formula, the contribution margin income, and the cost volume profit chart. Break-even is the sales level at which operating income is zero. Fixed costs equal total contribution margin, or total sales equal total expenses. Sales below break-even, you're going to have a loss, and above, you're going to have a profit. So, break-even in units is going to be the fixed expenses plus, now, if you had a targeted revenue, you would add it to this formula to tell you what you need in units to achieve a certain net income. But in this case, we're assuming it's zero, and you're going to divide by the contribution margin per unit. That's going to give you break-even in units. Now, if you want break-even in dollars, it's going to be your fixed expenses divided by your contribution margin ratio. Assume targeted net income is zero when you're doing break-even. So let's look at an example. Now, Mike's manufactures a single product. He sells for $180, and the variable costs are $135 per unit, and we have our annual fixed costs. We need everything. We have everything we need to solve this problem. First, let's compute the company's contribution margin, which is $45 per unit. The contribution ratio is going to be the 45 divided by the 180. It's 25%. So what that means is every time you sell something, you're going to end up with 25. Every dollar you sell, you're going to end up with 25 cents to cover your fixed costs. Compute the company's break-even in units. It's going to be 12,500. Now, compute the company's break-even in dollars. It's going to be $2,250,000. So again, we use the contribution margin per unit to get units, and we use the ratio to get dollars. So when we do our contribution margin income statement method, we're going to take the same problem. So we end up with sales of $22,550 less our variable costs minus our fixed costs gives us 0. What if the company increased fixed costs by $50,000? What sales are needed to break even? So we take the fixed costs plus the change in fixed costs divided by the contribution margin percentage, and that tells us now we'd need sales of $2,450,000 to break even. Now, this is what the third way is the cost, volume, profit chart. We don't go over this, but you can look it over in your book if you want to learn more about that. This concludes part 2 for chapter 5, and we have one more part.